You wake up and see a number so large it stops behaving like a number. $40 trillion. You are told this is what the United States owes. The sentence sounds simple. The picture in your head is usually simple too. America borrowed money, somebody else lent it, and one day the bill comes due. But where is the creditor? Is it China, Japan, the Federal Reserve, your pension fund, the money market fund holding part of your savings, a bank, a government account? A company on the other side of the world that sold something into the American market? The surprising answer is not one name. It is a chain. Stay with me. It's like a warehouse receipt that can move through several hands. By the end of this video, you will be able to answer the question at 3 different levels. You will know the largest single reported holder sector. You will know why the largest named foreign country is not the same thing as the final beneficial owner. And you will see how a shipment leaving a factory can become a dollar claim, how that claim can become a reserve or an investment, and why one of its destinations is a Treasury security. The point is not that every dollar earned by a foreign producer becomes a U.S. bond. The point you are about to see is that trade, banking, reserves, and government borrowing occupy the same dollar system. To keep this from becoming a list of institutions, we are going to follow one real Treasury bill. Its identifier is 912,797 UU9. It was a 56-day bill. Treasury auctioned it on June 18, 2026. It was issued on June 23 and matured on August 18. At the auction, more than $197 billion of tenders were recorded. About $79.6 billion were accepted. The record separates bids into primary dealers, direct bidders, and indirect bidders. That sounds like the beginning of an ownership story. It is not yet the end of one. The bill will wait for us while we ask a larger question. What does it mean to own American debt? What answer would you give if someone stopped you in the street? China owns it. Foreign governments own it. The Federal Reserve printed the money and bought it back. The American public owns it through retirement accounts. Each answer touches something real. If you chose one of them, you have found a layer, not the whole question. You are looking at a market, not a single envelope. If you answered with a country, you are naming one location in the chain. If you answered with the Federal Reserve, you are naming one institution in the chain. If you answered with your pension, you are naming one possible route by which the claim reaches you. The first problem is that the 40 trillion headline and the tradable Treasury market are not the same ledger. Before you name a creditor, you have to know which ledger the headline is using. Picture this. You are standing in a warehouse while a receipt moves from the loading dock to a bank, then from the bank to a vault, then from the vault into a financing agreement. Imagine a warehouse receipt. It says that a claim exists. The receipt can sit in a filing cabinet. It can be sold to somebody else. It can be placed in a vault as a reserve. It can be pledged while a short-term loan is made against it. The receipt is one object, but it can perform several jobs as it moves through the system. A marketable Treasury security works more like that than like a household bill stuck to a refrigerator. It is a claim on the United States government, but it is also an asset that can be traded, stored, financed, and pledged. You do not have to memorize the vocabulary yet. You only have to keep watching what the receipt does. Treasury's May 31, 2026 Debt Position Report gives us a useful pair of numbers. Total public debt outstanding was about $39.031 trillion. Marketable debt was about $30.914 trillion. Non-marketable debt was about $8.294 trillion. The distinction matters. Marketable bills, notes, and bonds can be traded in the secondary market. Non-marketable government account securities and savings instruments do not behave the same way. So when we ask who owns the debt, we have to say which debt ledger we mean. The Federal Reserve's financial accounts offer another view. In the first quarter of 2026, the Fed recorded $30.6415 trillion of marketable Treasury securities held outside the federal government. You can hold both numbers in your head without choosing between them. That is not a contradiction. It is a different measurement, a different date, a different valuation basis, and a different question about what is held by which sector. If a percentage appears on screen, its denominator stays beside it. When you compare the figures, you are not being asked to choose the number that feels most dramatic. You are being asked to identify what each number is counting. Now the answer can descend through the layers. At the largest single reported sector level, the Fed's table puts the rest of the world first, at about $9.3172 trillion. That is roughly 30% of the Fed's marketable security denominator. It does not mean 30% is owned by one foreign government. Rest of world is a sector containing many countries, official institutions, private investors, banks, funds, and custody arrangements. The next large lines include the central bank category at about $4.0004 trillion, money market funds at about $3.4264 trillion, and households at about $3.039 trillion. Domestic holders, taken together across the table, are larger than the rest of world sector. That is the first reversal. The biggest single reported sector is foreign, but the wider domestic field is larger. Then comes the country question. The latest Treasury country table used for this episode places Japan above mainland China in reported Treasury holdings, approximately $1.117 trillion for Japan and $633 billion for China. Those figures are useful, but the word reported is doing important work. Imagine this as a stack of transparent maps. You can see the country named in one map, the custodian named in another, and the investor behind the account only if the records disclose it. Treasury warns that a security held for a German investor in a Swiss custody account can appear in the Swiss country position. A financial center may be holding securities for somebody who lives somewhere else. The country table is a window onto ownership, not a complete register of the final owner. So we now have three answers. The largest single reported sector is the rest of the world. The largest broad camp is domestic ownership taken across sectors. The largest named foreign country in the current table is Japan. Those answers can all be true at once. You can now separate sector, country, and beneficial owner. They are three different questions, even when a headline compresses them into one. If you keep those questions separate, the mystery becomes a map. Now we bring the factory into the story. When a foreign producer ships goods into the United States, the exporter receives dollars through the banking system. The exporter may use those dollars to buy American goods or services. A company may buy private U.S. assets. A bank may hold deposits. A central bank may accumulate foreign exchange reserves. The dollar has not disappeared. It has changed hands and changed balance sheets. The balance of payments identity gives us the macroeconomic bridge. When the United States runs a current account deficit, the rest of the world accumulates in net terms claims on U.S. residents. That is the connection we need to make visible. You can follow the connection without claiming that every exporter personally selected a Treasury bill. The system-level relationship is real even when the final transaction is hidden inside banks, funds, or custody accounts. The factory does not wire money directly to a Treasury bill. The factory creates a trade flow. The trade flow creates dollar claims. Banks, funds, and reserve managers decide where those claims sit. Treasuries are one destination because they combine a deep market with liquidity, reserve usefulness, and the ability to be traded or pledged. The flow looks like this. Where does the claim sit next? Who has the balance sheet, the reserve account, or the financing need that gives the dollar its next destination? You can ask those questions at every handoff in the chain. The arrows are the story. The arrows are not all the same kind of evidence. The trade data show the goods flow. The balance of payments accounts show the accounting relationship. Institutional records show what reserve managers and financial intermediaries can do with dollar assets. You can test each arrow separately instead of forcing one source to carry the whole chain. If you keep the arrows separate, you can make the connection stronger without making the claim larger than the evidence. That is how the chain stays visible without pretending that one receipt has a name printed on the back of one Treasury bond. You are following a conversion of claims, not a single payment. The useful question is where the dollars can go next. Here is the comparison that makes the mechanism visible. In 2025, the U.S. goods deficit with China was approximately $202 billion. The U.S. goods deficit with Japan was about $64 billion. Yet Japan's reported Treasury holdings were higher than China's in the latest table used here. If the story were a straight pipe, goods leave one country, dollars arrive, the same country buys an equal amount of Treasuries, the bars would line up. They do not. That mismatch is not a failure of the trade connection. It is evidence that the connection runs through more layers. If you expected the bars to line up, the mismatch is the clue. You are seeing flows and stocks meet inside a system that can reroute dollars. Japan's holdings can reflect official reserve management, private portfolios, secondary market purchases, and custody structures. China's reported holdings can change while other dollar assets, domestic policy, and reserve composition change around them. The bilateral trade balance is a flow measured over a period. Treasury holdings are a stock measured at a point in time. They are related through the international financial system, but they are not interchangeable numbers. You are not being asked to distrust the trade data. You are being asked to use it at the level it can actually support. You can therefore use trade data to locate pressure in the system without using it as a receipt for the ownership of a particular security. You are not being asked to distrust the trade data. You are being asked to use it at the level it can actually support. Return to the bill. You have seen where it was born. Now watch what it can do after the auction. At its auction, the largest accepted competitive channel was indirect bidding. But Treasury defines indirect bidders as customers placing competitive bids through a primary dealer or direct submitter. The category can contain domestic or foreign bidders. It tells us how the bid entered the auction, not who ultimately owned the security. After issuance, the bill enters a market where dealers distribute and finance securities. A Treasury claim can be held for its return. It can be held because it is liquid. It can be held because a bank, fund, or reserve manager needs a dollar asset. It can be pledged as collateral in a repurchase agreement. In a repo, one party receives cash and temporarily transfers a security. The security comes back when the agreement is unwound. The Treasury claim has become part of short-term funding infrastructure. If you follow the claim past the auction, you find a financial tool rather than a static pile of debt. Research on Treasury reuse describes a collateral multiplier. Securities can be reused so the safety benefits of a limited pool reach more investors. New York Fed data treats tri-party and GCF repo as a market that provides short-term funding for dealers and supports liquidity in fixed-income markets. You can picture the bill moving through this market without its economic role staying fixed. In one moment, it is an investment. In another, it is collateral supporting a cash loan. That is the deeper reversal. You can see why a buyer might want the claim even while the United States sees it as a liability. The United States is borrowing by issuing a liability. The market is buying it because the same liability is useful as an asset. That does not make the debt harmless. It explains why the market can absorb so much of it, and why a change in the market's ability to absorb it matters beyond the Treasury's own accounts. The pressure point is not a single day when every creditor arrives with a suitcase. The pressure point is replacement. The 56-day bill matured on August 18. A short bill like this is not an ancient debt that waits silently for a final settlement. It is part of a rolling sequence. Treasury pays a maturing claim and issues new claims as financing needs continue. If new borrowing costs more, the cost of replacing old borrowing rises. If dealers have less balance sheet capacity, distribution can become harder. If collateral becomes scarce or funding rates move, the market's plumbing becomes more sensitive. The Congressional Budget Office projects net federal interest outlays of about $1 trillion in 2026 and about $2.1 trillion in 2036. Those are projections, not a prediction of a crisis. They show why the rate paid on a large refinancing machine matters. Scholars disagree over the size and timing of foreign demand effects on Treasury yields. You do not need a single estimate to see the mechanical exposure. More debt has to be refinanced, and the price of that refinancing matters. You can now see the loop in both directions. You are watching a schedule, not waiting for one dramatic creditor to appear. If you are holding a fund, a deposit, or a retirement account, the refinancing question can reach you indirectly through the assets and rates attached to that account. Foreign production and trade can send dollar claims into the system. The Treasury supplies an asset that absorbs some of those claims. Financial institutions use that asset to manage liquidity and collateral. The U.S. government then depends on the market remaining willing and able to refinance the claims it has issued. The same structure that makes borrowing possible also makes market conditions important. You can see the vulnerability without turning it into a prediction of collapse. You can trace that vulnerability back to the same claim that looked safe and useful at the auction. So who owns America's $40 trillion debt? You can answer the question now, but only if you keep the levels separate. The first answer is a reported sector. The rest of the world is the largest single line in the Fed's marketable security table. The second answer is a broad field. Domestic sectors together hold more than that single foreign sector. The third answer is a country. Japan is the largest named foreign holder in the current table used for this episode, while the country field still cannot reveal every beneficial owner behind every custody account. You can report that country accurately without pretending it explains the whole market. And the deeper answer is a mechanism. The United States issues claims. Other countries earn dollars through trade and finance. Banks, funds, households, central banks, and dealers decide where those claims live. Treasuries are attractive not only because the government promises repayment, but because the claims can circulate through a market that uses them for liquidity, reserves, and collateral. You are looking at a system in which the same claim can matter to several different holders for different reasons. The bill we followed did not lead to one secret creditor. It led into a network. You began with a headline. You ended with a chain of claims, institutions, and uses. When the headline says America owes $40 trillion, the important question is not only who gets paid. It is why so many parts of the world want to hold, trade, finance, and reuse the claim in the first place. That is the part of the debt story you can miss when you look only for a country name. Once you see the mechanism, you can ask better questions of the next debt headline. Which ledger, which holder level, and which link in the chain? The number still points to a creditor, but the creditor is a network. The creditor question is the reason the headline needs a mechanism behind it.